Most investors think rising interest rates are the biggest threat to real estate in 2026, but that's not what's quietly destroying returns behind the scenes. Welcome back to the Globe Realty. In today's video, 10 California property tax laws that could ruin your investments in 2026. We're exposing the tax rules and policy shifts that are silently draining cash flow, reshaping retirement plans, and catching even experienced property owners off guard. These aren't rumors or speculation. Every point in this video is fact-driven, rooted in current laws, voter initiatives, and tax policy changes already affecting homeowners, landlords, and long-term investors. Some of these laws look minor on paper, but when you see how they stack year after year, the financial damage becomes clear. If you own property, plan to retire on real estate income, or expect to pass assets to family, this video could change how you view your portfolio in 2026 and beyond. Watch all the way through. The final law may be the most important one for protecting your investments. And if you want real estate insight without the hype, like the video, subscribe to the Globe Realty and stay locked in. Number 10. Supplemental property tax bills. Let's talk about one of the most unexpected financial blows to real estate investors, supplemental property tax bills, and why this little understood law is quietly ruining returns in 2026. When you buy a property, you're familiar with your regular annual tax bill based on the previous owner's assessed value. But in California, state law mandates that the county assessor immediately reassess your property at current market value once ownership changes or new construction is completed, and that triggers a supplemental assessment. This assessment fills the gap between what the seller was paying and what you should be paying based on your purchase price. Here's where it gets ugly. If you close between January and May, state rules often generate two separate supplemental tax bills, one that covers the remainder of the current fiscal year and another for the entire next year. That means you could see thousands of dollars due on top of your annual tax bill, long after you've moved in. Ask yourself this: did your escrow estimate prepare you for this? Is your lender even factoring this into your impound account? The harsh truth is, most lenders don't pay or escrow supplemental taxes automatically, and the bill lands directly in your mailbox months after closing. What's worse, because the assessor mails these bills separately and on a different schedule than your regular tax bill, many investors don't budget for them, leading to penalties if they aren't paid on time. Some homeowners have even reported multiple supplemental bills totaling 0.75% to 1.25% of purchase price or more, depending on timing. Meaning, a $1 million investment could bite you with $7,500 to $12,500 in one-time supplemental taxes you weren't ready for. This is no minor administrative quirk. It's a predictable cash flow hit that can erode short-term returns, drain cash reserves, and squeeze your investment strategy if you're not prepared. How widely are investors budgeting for this now? And who's really educating buyers before it's too late? Number 9. Initiative to repeal key Prop 19 rules. Here's one that's stirring up real controversy in California real estate circles, and it's not just about taxes. It's about who gets to keep generational wealth. This is a statewide initiative aimed at rolling back critical parts of Proposition 19. Now, Proposition 19, passed by voters in 2020, dramatically changed how inherited properties are taxed. Under Prop 19, when a parent passes a primary residence to a child, the child can only keep the parent's property tax base if they move into the home and make it their primary residence within a short window. That shifted inheritance rules and triggered reassessments that have hit family portfolios hard. But late in 2025, a movement surfaced to repeal these key transfer rules. If this initiative qualifies for the ballot and voters approve it, families could transfer homes without reassessment, allowing children to retain the same low property tax base indefinitely. That sounds great in isolation, but this isn't just a tax break. It's a potential economic earthquake. Here's the controversial part. Keeping property taxes artificially low for heirs could drain billions from local budgets, money that currently pays for schools, roads, and emergency services. Some analysts estimate a massive drop in property tax revenue if the repeal passes, because reassessments of inherited properties would disappear almost overnight. Ask yourself, should law favor family wealth transfers over neighborhood services? If wealthy investors and multi-property families can indefinitely freeze low tax bases, does that unfairly benefit the rich at the expense of the public good? And don't forget, this change wouldn't just help retirees passing on homes. It shifts incentives across investment planning, estate strategy, and how assets are held long-term. If you thought Prop 19 was expensive, wait until you see the unintended consequences of undoing parts of it. This isn't just a law. It's a debate about fairness, wealth, and the future of real estate investing in California. Number 8. Property transfer tax battles and ballot measures ahead. You might think property tax changes are limited to assessments and supplemental bills, but local governments are getting bold with property transfer tax proposals, and this could dramatically alter the math on high-value real estate investments. You've probably heard whispers about that insane 5,500% San Diego transfer tax hike that was recently canceled in early 2026 after massive backlash from investors, homeowners, and business groups. But here's the controversial truth. The idea didn't die, it just went underground. Local ballot measure strategists are now drafting new transfer tax proposals aimed at luxury properties, estates, and high-end sales that could surface as soon as 2026 and 2027. Are you prepared for a tax that could add tens or even hundreds of thousands of dollars to the cost of selling your asset? Because unlike traditional property taxes, transfer taxes hit at the moment of sale, directly reducing your net proceeds and your return on investment. Data from metropolitan areas shows that transfer tax proposals have skyrocketed in both frequency and magnitude since 2023, especially in booming markets with high median prices. Some jurisdictions have flirted with taxes ranging from 1% to 4% of the sale price. And in luxury segments, that's real money. Here's the unsettling part. These proposals are gaining traction among city officials looking for ways to fund public services without raising homeowner ad valorem rates. But the result? Investors get hit twice, first by rising assessed values and now by steep transfer levies. And while proponents paint these taxes as fair shares, critics argue they chill market activity, reduce liquidity, and effectively penalize success, especially for those who bought early and benefited from long-held cap advantages like Prop 13. So here's the question for you. Is your investment strategy ready for a tax at exit, not just ownership? This isn't imagination. This is political reality creeping into your ROI. Number 7. Proposed increase in homestead homeowners exemption, SB 566. Now we hit one of the most controversial pieces of tax reform chatter shaking up investor circles. The proposed Senate Bill 566, which would hike the homeowner's exemption from a tiny $7,000 to a whopping $50,000 of assessed value, but only for those 62 and older. That's almost 7 times jump in what's been a staple of California property tax law for decades, and it's igniting both hopes and fears. Right now, the state constitution allows homeowners to shave $7,000 off their assessed value if the home is their principal residence, which, in high-priced markets, translates to maybe $70 to $100 in tax savings per year. It's almost symbolic at this point, but SB 566 would boost that exemption to $50,000, meaning up to $500 to $600 plus in annual tax savings for eligible senior homeowners. On paper, that sounds like much-needed tax relief, especially for retirees on fixed incomes. But before you celebrate, let's get controversial. This isn't free money, it's a massive revenue hit. Analysts project the exemption increase could cost the state and local governments around $817 million per year in reimbursements. So investors have to ask, who actually benefits the most? Sure, seniors see some relief, but this move does nothing for younger investors or the next generation of homeowners who are getting crushed by rising property taxes, rising mortgage rates, and shrinking returns. Plus, because the bill doesn't guarantee full reimbursement for local agencies, school districts, and public services could lose funding or shift costs elsewhere. often back onto property owners through other fees or assessments. And here's another twist. The bill ties the exemption to age, not wealth or need, meaning high-value property owners could also profit handsomely while lower-income investors get little to no help. So the big question for you as an investor is this. Is this tax break smart planning or a distraction from the deeper fiscal challenges facing California real estate? Number 6. Expanded disaster-related tax installment protection. We're diving into a law that sounds helpful on the surface, but could actually expose investors to subtle cost pressures and planning pitfalls you're not expecting. In 2026, Assembly Bill 1416 takes effect, expanding disaster-related property tax protections so that if you've applied for a tax installment plan before a disaster, you're now automatically eligible for relief, even if the plan hasn't been formally processed when calamity hits. Essentially, good faith requests for payment plans count the same as approved plans in disaster scenarios. Look, disaster tax relief has been around for years. California's property tax code allows owners whose homes are damaged by wildfire, floods, earthquakes, or other major crises to reassess based on the damaged condition and even defer payments without penalties while you rebuild. The loss must be substantial, often at least $10,000 or a significant percentage of market value, and you must file within strict time windows. At first glance, that looks like a win, but here's the controversial twist. AB 1416 effectively transfers administrative risk from counties to taxpayers. Instead of ensuring counties expedite processing of installment plans, the new rule just papers over slow government action by assuming your request was good enough. That might sound fair, until you realize it does nothing to speed up actual relief or protect investment cash flow. Many investors caught in disasters historically end up paying extra fees and interest because counties delay plan approval long enough for penalties to accrue. Then relief is retroactive, but cash flow damage is already done. With AB 1416, you still might wait months for processing while your carrying costs balloon, especially in markets where insurance and construction costs are spiking. Should tax relief focus on faster government response or on retroactive forgiveness that lets taxpayers eat the delay cost? This law doesn't fix the underlying inefficiency. It just shifts where the pain lands. And when disasters increase in frequency and severity, as climate trends show, investors could be left dealing with higher operating costs, delayed recoveries, and strained cash reserves, precisely when they can least afford it. We are midway through this countdown. Hit that like button, subscribe to the Globe Realty, and turn on the notifications. Now back to the top 5. Number 5. Emergency property tax relief for disaster areas ends. This is a law that sounds like relief, but could quietly hurt your investment strategy if you're not paying attention. In early 2025, California's governor issued an emergency executive order that extended property tax deadlines and waived penalties for homeowners in firestorm-impacted areas, especially in and around Los Angeles. That meant property owners could defer tax payments and avoid late fees while they focused on rebuilding after devastating wildfires. But that special protection ends on April 10, 2026, and the consequences are bigger than most investors realize. Here's the crux. This wasn't just a deadline extension. It pushed significant property tax liabilities into the spring. And that matters because timing impacts cash flow, refinancing decisions, and overall portfolio returns. Many investors expected staggered annual bills, but instead found a massive lump sum coming due all at once. That's a shock to cash reserves. Ask yourself, did you budget for a delayed $10,000 to $30,000 tax bill landing in spring instead of winter? Because many didn't. Now that the relief window is closing, counties are gearing up to process months of backlogged taxes, penalties, and interest assessments. Even with relief factored in, the administrative surge means more notices, more confusion, and more opportunities for errors that can trigger penalties if not handled perfectly. In some counties, the backlog stretched into tens of thousands of assessments due all at once, making it difficult for investors to plan liquidity or refinance before the tax deadline. Here's the controversial part. This so-called relief may have created a ticking time bomb. By pushing liabilities forward rather than restructuring how assessments are calculated, the state temporarily helped wallets, but worsened future planning. Many investors will now face higher effective carrying costs when they didn't expect it. So let me ask you directly, are you prepared for a big tax hit this spring, or will your cash flow get squeezed when you least expect it? If tax timing can disrupt your investment returns, then number 4 will push your planning even further. Number 4. Prop 13 inflation adjustment still caps increases. Let's unpack the most famous and most misunderstood property tax rule in California history, Proposition 13. Many investors assume Prop 13 is a full shield against rising property taxes, but if you're relying on it to protect your investments in 2026, you might be dangerously mistaken. Here's the plain truth. Prop 13 limits assessed value increases to a maximum of 2% per year, regardless of how fast market values climb. That's the part everyone knows. But here's the part most investors don't fully grasp. Modest isn't the same as insignificant. In the last assessment roll before 2026, the vast majority of properties did hit that 2% cap, even in high-performing markets. That means investors and homeowners still saw their tax bills grow each year. Not because market values skyrocketed, but because the cap systematically ratchets assessments upward by the maximum allowable amount. That's incremental tax pressure that adds up fast. Would you tolerate a silent 2% annual tax increase on your investment year after year, without ever thinking about it? Many investors don't even budget for it, assuming Prop 13 means no tax increase, when in fact, they're still paying real money that chips away at cash flow and returns. Here's another controversial point. Prop 13's 2% cap doesn't apply only to residential property. It also protects commercial property owners. That means big investors with political clout benefit from the same limits as grandma next door. Yet many residential real estate investors feel the squeeze because their assessed values are still climbing. And if they make improvements or transfers occur, reassessments can occur outside the 2% rule. In other words, Prop 13 doesn't stop increases, it slows them. But in a world where inflation, labor costs, and maintenance expenses are all rising faster than that 2% cap, this law may give investors a false sense of security. So ask yourself, is your financial planning treating Prop 13 as a ceiling or a crutch that hides real tax pressure? When you ignore that distinction, your investment strategy could be in deeper water than you think. Number 3. Zone 0 Wildfire Safety Rules. Let's dive into the law that hits investors in the pocketbook long before any tax bill arrives. The new Zone 0 Wildfire Safety Rules, effective February 1, 2026. On paper, this is framed as a safety measure, but in reality, it's reshaping property costs, insurance eligibility, and indirectly, your overall returns. Here's what you need to know. The law requires homeowners in fire-prone areas to remove all flammable materials, including plants, fences, and combustible structures, within 5 feet of any home. Compliance isn't optional. Both insurance companies and local authorities can enforce this. Non-compliance could jeopardize property insurance coverage, leaving your investment extremely vulnerable. Let's talk numbers. Depending on the size of the property and how much mitigation work is needed, costs can range from $2,000 to over $20,000 per property. For multi-property investors, that's a real immediate cash flow impact, not a theoretical future expense. And here's the kicker. If your insurer refuses coverage, you may be forced to pay higher premiums or even self-insure, which indirectly inflates your effective property tax burden because insurance costs often factor into your overall carrying costs. Have you included wildfire mitigation costs in your ROI calculations? Most investors don't, and that's why this law is quietly dangerous. It also raises a controversial point. While the rule protects communities, it disproportionately affects investors in high-risk zones who may already be facing escalating property taxes, supplemental assessments, and rising insurance costs. Essentially, it's a triple squeeze on your bottom line. And don't forget the enforcement side. Local authorities can issue fines for non-compliance, adding yet another unexpected expense. The law essentially shifts a large portion of fire mitigation responsibility and cost onto the property owner, while doing little to directly reduce overall tax liability. So the question is, are your California investments ready for this new wildfire reality? Because failing to comply could hit your portfolio harder than many annual tax increases. Number 2. Hundreds of new state laws take effect. Now this one isn't flashy, you won't see it in headlines, but it has real teeth for property investors. The hundreds of new California laws that took effect on January 1st, 2026. Most aren't property taxes in the traditional sense, but they impact how taxes are calculated, filed, and enforced, and ignoring them could cost you big. Here's the fact. Starting this year, California enacted laws covering everything from consumer protections, housing regulations, wildfire mitigation, and administrative tax processes. Some rules seem minor, updating filing deadlines or modifying reporting formats, but in practice, they can trigger compliance issues that hit your cash flow or even your eligibility for certain deductions or exemptions. For example, some new laws tighten documentation requirements for property tax exemptions or credits, meaning if your paperwork is missing a single signature or form, your claim could be delayed or rejected, and late payments generate interest and penalties. It's an invisible squeeze on your wallet that many investors overlook until the bill arrives. Are you really tracking how new administrative rules affect your portfolio? Most investors think only of market appreciation or interest rates. But your returns are increasingly dependent on navigating the maze of new fiscal compliance requirements. And here's where it gets controversial. Some of these laws indirectly increase the cost of owning or transferring property without technically raising the tax rate. For instance, changes in reporting requirements for rental units or wildfire-prone properties could require professional appraisals or engineering reports to maintain exemptions, easily costing thousands per property. In other words, the state is raising the cost of compliance, quietly eroding investor cash flow while keeping nominal tax rates unchanged. So while you might not see a big headline number on your next property tax statement, the hidden compliance costs and penalties are real. And if you're not proactive, they can quietly destroy ROI. The question every investor should ask, are you keeping up with these administrative changes, or will 2026 be the year unseen laws silently drain your portfolio? Number 1. One-time wealth tax proposal. The Billionaire Tax Act. Now we've reached the law that's causing the most buzz and controversy in California real estate circles. The proposed 2026 Billionaire Tax Act. On the surface, this isn't a property tax. It's a one-time 5% levy on residents with net worth over $1 billion. But the ripple effects on real estate investments, luxury housing, and even regular homeowners' tax burdens could be enormous. Here's why investors need to pay attention. When ultra-wealthy Californians face a sudden asset-based tax, many respond by reallocating wealth into real estate, trust structures, or high-value properties. That could push up home prices in certain luxury markets while also increasing property tax exposure for others. Because when high-value homes change hands, supplemental property taxes and reassessments follow. In essence, even if you're not a billionaire, your neighborhood and market dynamics can shift dramatically, affecting both carrying costs and long-term ROI. Consider this. California already has some of the highest median home prices in the country, with areas like Los Angeles, San Francisco, and Silicon Valley averaging $900,000 to $1.5 million per home. A sudden influx of capital into property markets to offset wealth taxes could exacerbate affordability pressures, artificially inflating assessed values over time. That's a hidden tax hit many investors don't account for until they sell or refinance. And here's the controversial angle. The law could inadvertently create an incentive to park wealth in real estate rather than liquid assets, meaning property taxes, maintenance costs, and insurance premiums rise, while liquidity shrinks. Essentially, California could be driving investors into its own housing market, and indirectly, into higher ongoing tax exposure. Are you prepared for a policy that doesn't directly touch your property, but could still reshape your portfolio and costs? Even if you're far from the billionaire threshold, the secondary effects of this tax, from rising home values to increased supplemental assessments, could quietly erode returns. That's why the 2026 Billionaire Tax Act takes the top spot. It's not just about who pays, It's about how real estate investment behavior and cash flow are being quietly influenced across the state. And there you have it, the wrap-up of our countdown on the 10 California property tax laws that could ruin your investments in 2026. From supplemental tax bills quietly hitting new homeowners to the Billionaire Tax Act subtly reshaping real estate behavior, it's clear that the landscape is shifting and the risks are real, even for savvy investors. Each law we covered, whether it affects retirees, landlords, or long-term homeowners, has the potential to quietly erode cash flow, raise carrying costs, or force tough financial decisions if you aren't prepared. The key takeaway here is this: knowledge is your best defense. California's property tax environment isn't static. It's evolving in ways that can surprise even experienced investors. Paying attention now, understanding each change, and proactively adjusting your investment strategy can save you thousands, if not hundreds of thousands, in the years ahead. So ask yourself, have you reviewed your portfolio in light of these 2026 laws? Are your retirement plans, estate strategies, and investment forecasts aligned with the new rules? Ignoring these changes isn't just risky, it's expensive. If this video gave you a clearer picture of what's coming, hit the like button, drop a comment sharing your experience or questions, and subscribe to the Globe Realty for more real estate insights that most investors don't find until it's too late. Stay informed, stay strategic, and protect your investments, because in 2026 the rules have changed, and every homeowner and investor needs to be ready.